This is Chris Carlson, and welcome to the Boulder Banking Podcast. My guest is Jason Mork, director at Piper Sandler. Jason is a graduate of GSBC and currently serves on the faculty of GSBC. This was a fascinating conversation in which Jason took us behind the curtain of what banks are doing in terms of their investment strategies. We also talk about the current state of the economy and what Jason thinks banks should be doing. Jason, thanks for joining us today.
Good afternoon, Chris. Thank you for having me. Looking forward to our conversation.
Well, Jason, there's some fascinating things that we're going to talk about today. But before we get started, can you give us a brief background of Jason Mork?
Absolutely, Chris. I've been in banking for over 25 years. I actually began as a teller in college and have worked my way up from there. So I have experience on the retail side of the bank, as well as spent some time in a management training program that exposed me to the operations side of a bank, went through an audit department, and I actually ended up in commercial lending for 5 years before I moved over to capital markets. Being here in capital markets for the last 15 years, I specialize in working with community banks, not just as a broker dealer, but also as a registered investment advisor. So I really like to get into things well beyond just dealing with bonds with my banks. I get involved with annual budgeting, strategic planning. My goal is really to get to know a bank and their balance sheet so that I can work with the things I work with and make sure it's aligned with the entire goals of a bank.
Well, Jason, tell us what type of services Piper Sandler provides to the banking industry.
Sure thing. Piper Sandler came together a couple of years ago when Piper Jaffray acquired Sandler O'Neill. So both well-known names, but both with different specializations. Sandler O'Neill was well known as having, being one of the best niche investment banks in the business, specifically working with banks, things like M&A, capital raising, things like that. Obviously, they do everything for banks. Piper Jaffray, who acquired Sandler, was looking to get better in the financial services space, was able to make the acquisition and pair it with its very strong trading and underwriting platforms, and bring some breadth in terms of all the different markets we cover. So we specialize in a number of sectors, and our philosophy is we want to be top 3 in all of the sectors that we cover, and that's really why we made that acquisition. In terms of what we do for banks, we have extensive services. As I mentioned, everything from helping newly formed banks raise capital to banks that are growing a little further down the road who might want to go public. We work with that. Mergers, acquisitions, anything related to investment banking, we specialize in. Where I come in is we have a very large bank strategy group that I work closely with. And, we do everything in terms of balance sheet analysis to help banks figure out where they are, where they want to go, what they should be doing. And, I find myself to work very closely with that strategy group because in the way I see the world, if you're a banker, the first thing you need to do is really understand your liability position to begin with. And from there, you can start out to map out where are you on the asset side and what needs to be done. And that's the order you need to work in when you're working on the asset side of the balance sheet, which is what I ultimately specialize.
So you are kind of like Mr. Inside Baseball when you're working with a bank then.
Yeah, to a degree. It's nice to be able to work with the number of banks I work with. I think I get a lot of color from my banks. Most situations I run into, I've dealt with something similar before. So I think that's one of the unique advantages you get sitting in the chair I sit in. And once in a while, you are pleased to run into something new, and then you're able to share that with everyone else. So that works well.
Well, one of the things that really intrigued me about our conversation today, Jason, I was kind of wondering, what type of investment acumen do most banks have internally when it comes to their balance sheet?
That's a great question. And I'll say that is as unique to each bank as, I like to think of each bank. I look at their balance sheet and their roster of their management team. It's always unique. That's what's fun about working with banks. And, in terms of their investment acumen, sometimes I'm working with someone who, has sat in a similar chair to me, or maybe one that's a couple steps above where I'm in, and they know as much as me, if not more than me. So sometimes you have a real deep relationship with someone who, I have a very peer-like working relationship with them. Other times I might be helping a bank that doesn't have anyone with any investment experience at all, or it's very limited. That's where we do a lot of mentoring and education with those people. Those are some of my best relationships. I look at myself as an outsourced employee for banks. And, usually it's like, do you want to hire a professional who works on your trading desk to come and do consulting work for your balance sheet? And I think that's a great solution for a lot of my smaller clients who, even when they're bringing in a CFO, that person might have a lot more of an accounting focus than a financial focus.
Where do banks get it right when it comes to their investment strategies?
I think most banks get it right in that they really understand how the investments impacts go to their CAMEL scores. They know the role of their portfolio, what it's supposed to be. They usually have a board level understanding of their investment policy. And they're also usually conservative, which in times like this really helps them. Banks are cautious by nature. And I find that some of the challenges with them is getting them to move outside their box. But in volatile times like this, knowing what you do and knowing your box can bring a lot of safety to them. The other thing that they get that has been evolving that they get right is I've seen them over the last 10 to 15 years really get more proficient on the asset liability side in terms of modeling, ALCO, and having that balance sheet driven input feed into that investment process. That used to not be the case, especially prior to 2007, 2008. I'll say that was the exception rather than the rule, where now it's becoming more than 50% of banks are probably taking that balance sheet driven approach, driven by a strong AL process, really taking that understanding of, what are my liabilities? What are my funding sources? Where are my current risks elsewhere in my balance sheet? And how do we consider all of those facets into what we do in the investment portfolio? Because many times I find that investment portfolio is a plug figure for things you'd like to do, but you might not be able to do in your market, or some risk you need to hedge that there's no better way to do it.
Well, let me do a 180 on you. Where do banks sometimes get it wrong when it comes to their investment strategies?
Well, I'm glad you used the word strategies in that question, because the first thing I would say is not having a strategy is the number one thing. We do what we do. It's almost a black box. It's what we've always done. This is what we're going to do. They don't incorporate it into that strategy process that is looking at the whole balance sheet, trying to assess the risk to maximize outcomes. The second thing is not differentiating between a strategy and what's your investment policy. To me, an investment policy is a ultimate level of risk management. It's 30,000 foot. It is some hard guardrails to keep you in between. But that's not meant to be your strategy, of course. So what you run into is people who tighten their policy too much, not saying, hey, my policy is something to present to the board. We're never going to do these things. I tell my regulator that. But then within that, I have a strategy that maintains a margin of error on both sides that falls within those guardrails, to continue with that analogy. And then I keep my strategy going. And then, of course, there would be tactics within strategy. So I find that some people just are like, here's our policy, here's what we buy. And my comment usually is, well, you shouldn't be buying the policy, because things change a lot, as we are going through right now. One thing I mentioned when I was giving that answer was black box investing. I still, pull call reports at the end of a quarter, and you can still find banks that look like that they've bought the same thing through all different interest rate environments in all different markets for 20 years, and they don't change what they do. And again, that can be a positive because you know your risk, you know what you're doing. But the negative is you have different risks you need to manage, and you're probably not doing that if you're not rotating what you're doing on the bond side. And the last thing I would say is not having the right partners or managing your relationships properly. I recently, as I was getting ready to talk to you today, I was thinking about where did this come into play recently? And I've recently started working with a CFO who I knew, who took on a new CFO job at about $1 billion bank. He kind of came in, and he was a new CFO, and he said, hey, can you help me on the investment in ALCO side? And of course, that's what I do. So I was thrilled to get the phone call. But as I got in there and started doing an overview to give him my opinion of what's going on in his balance sheet and what's his investment portfolio look like. And this was 6 months after he took the job, or a year after. So he had been there for a while. I'd uncovered some risks that were at the level of their real concerns about some of the things that he was purchasing. And he didn't buy them, but his predecessor had purchased all of these bonds that I found were full of extension risk, and they had structures that were going to break. And, they're driven by someone who had the philosophy of, I'm just going to buy what I buy, and I'm going to tell people what I want. And I'm going to go out to the market 1 day a month, 2 days a month, pick up the phone and tell 3 people what I want, and then shop them against each other. And as I went into there, nobody was doing the strategy piece. Nobody was looking at the global balance sheet to drive that strategy. And nobody was really looking out for this institution at the end of the day. And when I sat down and explained what he owned, he asked me, he said, how come no one has ever told us this before? And I said, probably because I knew who the predecessor was. I said, A, you didn't ask, and B, you kind of treated everyone like shopping between Walmart and Target, to pick on 2 things. Like, okay, I'm going to go buy this thing, and I'm going to go to 2 stores and see their price and just go where it's cheapest. And I think that really highlights what can go wrong absent a strategy and relationship.
So it begs the question, do banks have to be on the lookout for being, quote unquote, sold by their broker as opposed to looking out for their best interest?
Absolutely. I think that's an age-old question, and the whole reason that I've worked really hard to not say that I'm a bond broker here, and I cringe a little when people call me a broker. It has a connotation like being a used car salesman for a good reason. But I think when you start to peel back the layers of that, that can come out of how do you manage your relationships, and are you finding the right people? I start to think of being sold by your broker as the type of broker who, I'll say, used to exist a lot more, where they were calling with the bond of the day, and their business model wasn't to get to know you or your bank or do a lot of value add. They're just calling 20 people a day, 50 people a day, trying to sell a bond, which means if you're reacting to that, you're not partnering with anyone, and you're not having a strategy laid out where you have counterparties who know your strategy and are looking for those things. So, like I said, when you really look at their process, usually I think an internal process can you can end up there because of the process you have. So if that's a concern of someone, they're like, I don't want to be sold by their broker. My answer is, don't work with a broker who isn't transparent, who doesn't want to sit down and get to know you, and who can't make recommendations to you before they own bonds. Typically, when I get down to the actual bond side of things, we know what we'd like to buy well ahead of actually making that purchase. So we're actually going out and looking for the right things for their balance sheet, as opposed to reacting to someone calling and, hey, this bond's cheap, let's buy it.
Jason, how does a bank determine the right duration or timeline for their portfolio?
Well, that's a great question. I think the first thing a bank needs to answer when they look at that is, what portfolios do you have on your balance sheet? And one thing that I've really done, for the last 10 or 15 years with my accounts, I'll say this really was born out of what we went through in the financial crisis in 07, 08. A lost discipline, if you will, was you have multiple portfolios on your balance sheet at any time. I mean, if you're very fortunate and you have great funding that's very steady and tons of loan demand, you might have a small, what I like to call a core portfolio. And that core portfolio is designed to protect capital and provide liquidity for the bank. And it should be a pretty boring, short duration portfolio that doesn't have a lot of risk. Now, again, the whole idea there, as you heard me go through, that's a bank that probably has, 90 to 95% loan to deposit ratio, carrying maybe a couple percent to 5% in cash and maybe 5% of assets in their bond portfolio. But as we've experienced over the last couple of years, you find that a lot of banks had deposit surges. So they had all this extra cash coming into play, and they had a decision to make in terms of what are they looking to do with that excess cash. And as they were looking to that, you have 2 choices. You can deploy excess cash into your core portfolio, or you could start something what I like to call either a liquidity or a Fed funds alternative portfolio, kind of taking a page out of money market playbook, saying, hey, how do we build our own money market to just put cash in a cash alternative to beat Fed funds at zero? So those have been very popular, especially when we were sitting at zero rate environments that we're coming out of now. And the third portfolio that I think can exist on your balance sheet is a loan alternative portfolio, meaning I'm not generating the loans I need, which means now I'm going to have a bucket of investments that look and feel a little more like loans. So those probably carry a little more duration. They probably carry some credit risk because you're trying to buy some yield. So again, it goes to that comment I made earlier about having strategies and having a wide policy that lets you do these three things, but you realize I'm doing different investing for different things. Those are going to dictate that duration that you referred to. And, my last comment in terms of duration is that's why we need to get to know the rest of your balance sheet, because your funding sources in your balance sheet, both your capital and your deposit mix, and then understanding what loans you have and what you don't will usually give us that answer. And the final comment I have on duration is just understanding that duration versus maturity. And a very popular thing I hear from bankers everywhere is I don't make rate calls and I don't like to make bets on the curve. And my response is, well, as a bank, you're getting paid to make bets on the curve. But even more importantly than that, people can take that comment wrong. I'm not trying to tell people to take more risk. But my point is, anytime you buy something that is out on the curve over 30 days, the yield on the curve is basically driven by what the market thinks future interest rates are going to do. So anytime you're doing anything, whether, it's investing or even making a loan, and you're doing it on the 3-year part of the curve or the 5-year part of the curve being a big discounting mechanism is basically a big futures market. And you better understand what the market's saying about it. And we've just gone through a great example of that. 2 years ago, everyone thought rates were going to be at zero all the way through 2024, 2025 before we saw rate increases. Things changed, and obviously we have a lot of rate increases priced in. So even if you think you're not going to make a rate call or you're being neutral, buying a 3-year bond today or making a 3-year loan today provides you a yield that assumes 9 to 11 rate increases, where 2 years ago you could have been buying that same quote unquote neutral 2 to 3 year duration security and you were getting paid for 0 rate increases. And that's how I like to educate people on that topic.
That is fascinating. Thank you for that explanation. Well, Jason, a lot of the students at GSBC are future leaders of their bank. So how important is it that these future bank leaders, that they understand their bank's investment strategy?
Obviously, it's critical from my point of view. Every bit as critical is having a great algo process, because to me that in your investment portfolio accomplishes a few things for your balance sheet. As I said, at its core, it's a place you protect capital and it's a place you store very important liquidity. So with that in mind, that just answers the questions right there. But the other thing that your investment portfolio can do is one of the things we learn at GSBC is the value of bank sim, and where bank sim is so fun. You start to learn you're in a market and your market's not efficient, nor is it perfect, nor can you build that textbook balance sheet. There are risks on your balance sheet that frequently we can find an answer for in the investment portfolio. My favorite thing I like to point out is the only place that you can put bullet structured assets, meaning assets that go to a fixed maturity date and can't be called, refinanced, or taken away from you, is inside your bond portfolio. So if you find that your loan portfolio could easily be called, i.e. refinanced, people walk in the door and say, I want a new rate or I'm taking my loan somewhere else, you can hedge those risks in the bond portfolio. And that's why I think getting to understand the role it plays in your bank's annual strategy and your budgeting and risk management practice is what makes that so important.
Well, Jason, my last 2 questions, I'm going to kind of go a little bit more global if I can take a step back. And my first question is, what concerns you most about the current state of our economy?
Everyone, the obvious answer is inflation. We've been talking about inflation for a couple of years, but I want to take a step back. And I think it's really the fact that we have printed our way into this corner we're in, meaning all of the growth, we shut everything down. There was needed support for the economy. We've been printing money for 10 years through different ways, a little over 10 years, I should say, maybe 12, 13 years. But that growth was all driven by money printing. And what happened initially is that money printing was being done in the form of quantitative easing. We all, of course, remember, I want to say in 2010 to 2015 time period, we had a divided Congress and we weren't getting the stimulus the economy needed out of Washington. That's not my quote. That was Bernanke's quote when he was Fed chair. And so the Fed did it on their own. Well, this time around, because it was COVID was a pandemic and it was a global crisis, you had coordinated action out of Washington, and that money that came out of Washington went directly into people's pockets. And that money behaved very differently than the quantitative easing money. But that was also being done. But it seemed like where the Fed got behind, and it's easy looking backwards to say this, was the Fed was treating all of this stimulus money the same because it didn't get out into the wild. And that's always been the big debate on inflation. Everyone says, why isn't QE inflationary? And the answer is, well, Japan's been doing it for a long time. That money never gets into the wild. The money that gets into the wild gets put into our pockets. So here we are now, and you have the Fed tightening policy. Inflation is driven by global shortages, and our growth has been supported by money printing. And now we're at this intersection where those two things are at odds. And it's just interesting to me to think about how much pain is the Fed going to be willing to go through to fight inflation here. And none of us know because we're used to a Fed that rolls over quickly, which has been the case for the last 15 or so years. The Fed wants to be accommodative and support growth and support employment. They haven't had to deal with inflation. As a matter of fact, things were deflationary. And we're all sitting here in an uneasy state saying how much are rates going to go up? How dedicated are they to fighting inflation? Especially if we start to see softer growth. Is there going to be that point in time as we're looking at the yield curve? A lot of people are saying the market's telling me they're going to get up to about 3% based on what I see going on in the 10-year and the futures market. I feel very comfortable saying, hey, best odds, if you say, what's your best guess? Fed gets to 3. Well, it's a really popular thing to say the Fed won't get to 3. Why? Because they never quite get where they say they're going to go. You look at the last Fed meeting, they said, hey, we might go a little past 3. And I think that's just created a lot of fear and volatility in here. And I think we're in a market filled with risk right now, driven by things that are just really out of everybody's control. And it'll be interesting to see what path they choose.
Well, with all those challenges, what should banks be thinking right now?
First off, going back with my theme of our conversation today is what's going on with my deposits? Are they still growing? Have they leveled off? Am I seeing them leave? And planning for your future accordingly. I'm starting to see, as I look around different markets, we're starting to see just little cracks in interest rates. Banks are going to drag their feet on rates at a very slow pace because they are sitting with so many deposits. But you only need one bank in your market to start to get into a little funding trouble, and they're going to start raising rates to attract deposits, and then that's going to affect the whole market. So that's the first piece of things that I'm thinking about if I'm a bank right now. The second piece is on the loan side, how's demand going to go? Obviously, on the residential and retail side, that's very interest rate sensitive. The 30-year mortgage is up over 5%. If you're a bank who's been doing a lot of business in mortgage refinancing, that business is probably gone. And how are you going to make up for that income? Even if you're more commercially focused banks, so many companies have refinanced in the last 2 years and locked in really favorable terms. I think there's going to be a real lull in your commercial lenders knocking on doors and saying, hey, we'd like you to move over to our bank. Because they're going to say, hey, I'm locked in for a number of years at this other bank at, a very low rate. And I don't think you can move me. And then the final piece is just with that, the turbulence in the economy, the threat of a softening economy. I think it's going to impact business spending plans here. And I don't think you're going to see as many businesses going out and expanding, building a new plant, buying new equipment. I think people are going to have a more conservative position. So I do think there's a real threat to the asset side as well. And the final piece of that is, as you start to think about risk management at a bank, what we were just talking about with the Fed is I think you need to run legitimate rate shocks both up and down 100 basis points in here. It was so one directional for so many years. When rates were at 0, we knew we had nowhere to go but up. And now we're sitting in between where you have to consider what if rates, the one thing I will tell you about the yield curve is going back to what we were just talking about. Let's say the Fed only gets to make a number up 2%. And let's say we see negative GDP prints and unemployment rising. And at the same time, that causes oil to drop, which will take pressure off inflation. And of course, we have a strong dollar. If the Fed pauses, and we saw this in the mid-90s, when the Fed pauses, the whole curve's going to collapse on itself. So you could have a 3.5 10-year, a 3% 5-year, and then a 150 overnight rate. They pause. You got to be ready for rates all to drop back down under 2%. At the same time, Deutsche Bank has recently come out with a very scary scenario where they said the Fed's going to really hold true to fighting inflation. So much so they're going to raise rates into a recession and they called for 5 to 6% rates. That's about the most negative scenario I've heard so far. But again, if I'm running a bank, I'm saying, what if we're in a recession with high interest rates? That's another scenario you need to plan for.
That's why they need somebody like you.
Absolutely. Just to ask good questions, not because I have answers, of course.
Jason, you've given us a lot to think about, and I really appreciate that. But if somebody has some further questions on some of the ideas that you had presented, what's the best way for them to contact you?
Email's the best way to reach me. I can be reached at jason.mork@psc.com. So that's jason.mork@psc.com. And of course, everyone at the GSBC knows how to get a hold of me as well. And I would love to take any questions, comments, feedback. I love interacting with people. And that's why I was excited to do this with you today.
Well, Jason, I know you're a busy guy. And one of the things that I want to make sure that we do is, as we get closer to the school, is to make sure we have you back on and talk about one of the loves of your life, and that's negotiation. So I hope you come back and let us talk about that before the school starts.
Absolutely. I look forward to doing that with you as well.
Jason, thanks for your time today.
Thank you. Look forward to talking to you soon.